All right, we're going to get started. Welcome everyone to the Lumsden and McCormick Tax Cut and Jobs Act webinar. I think I know most of you on the call, but for those who don't know me, I'm Maria Gambacorta and I am the marketing director here at Lumsden. Before I get to introductions, we're going to go through a few housekeeping items. This webinar is being recorded and we will share the recording along with the slide deck with everyone within the next day or two, hopefully by Friday. So you can expect an email from us of the recording. It'll also be on our website. Both the chat and the Q&A are enabled. So if you have any technical questions for the presenters, if you could add them into the Q&A box, we're going to take questions at the end of each section. So Amanda's going to do the tax aspect. We'll take some questions, and then Austin will follow with the market update and retirement planning, and he'll take questions at the end of his. We are doing polling questions. The polling questions are required for CPE credit. There's 4 polling questions. We would ask that you answer all 4 of them. We're going to do something fun, some cyclorama building history. As many of you know, we moved back into the building after some renovations in January. So we'll share some cyclorama history. So again, if you could answer all 4 of those questions, polling questions, along with the evaluation that will automatically launch, those are all required for CPE credits. I'm ready to move forward with the introductions. We have Amanda Ornowski. She is a tax principal with Lumsden and McCormick, and she specializes in corporate tax and family wealth and estate planning. And Austin Robar is a financial advisor with Lumsden and McCormick Financial Services. He works with businesses to set up 401k plans and also with individuals for planning for retirement. So I did put links in the chat. I'm going to chat it to everyone now with their links to their bios. If you have any questions, you can follow up with them that way. Any webinar questions you can send to me. My email is also in the chat. And again, for CPE certificates, the email that the CPE certificate will come from is noreply@lcvista.com. And we will send that directly to you. So that's it for me. So I'm going to turn it over to Amanda. Thanks, everyone.
Thanks, Maria, and thank you everyone who's joining us today. So the plan for today is we'll be going over the expiring Tax Cuts and Jobs Act provisions, as well as an update on the market, like Maria mentioned. So I'm going to be starting off and then handing things over to Austin. Let's see if this advances. So we have a lot of different areas to cover today. This list is certainly not all-inclusive. We chose the most relevant provisions that are about to sunset for discussion. As I was going through each of these, as I was putting the webinar together, I started to really realize how many of the tax benefits created by TCJA have started to feel normal, as if that's the way it's always been and that's the way it's always going to be. So if nothing else, I'm hoping that we can shed some light today for everybody on what is currently set to sunset. So we're going to be starting out with just a little overview of why TCJA was enacted and looking at the impact of some of the expiring provisions. We'll go through changes that are going to be impacting individuals, businesses, and then Austin will be taking over from there. So TCJA was created to boost investment, create jobs, and increase wages while spurring overall economic growth. The provisions of TCJA lowered corporate tax rates. They provided individual tax cuts and attempted to simplify certain aspects of the tax system. All of the provisions were set to expire or phase out after 2025. Austin and I were joking as we were putting this presentation together that we hoped that nothing changed in a week leading up to today. And as fate would have it, I received an email less than an hour ago from Bloomberg that the House GOP is taking, says their first steps towards extending TCJA. So we will see what happens, but I do think this is actually very timely, given that they are looking at potentially extending some of this, so everyone can really understand what provisions are part of TCJA, what provisions you are actually using in your own individual tax scenario, and what is currently set to change, and it kind of gives you a little guide of what to keep an eye on into the future. And the impact of expiration, if that were to happen on taxpayers, is we would be looking at higher tax rates, fewer credits, decreased deductions, and really impacts on overall profitability and investment decisions. You know, if you kind of know what deductions may expire, that may impact some decisions that you're making in your business. So these are all things to kind of watch out for. So what we're looking at here is essentially your checklist of the major things expected to sunset at the end of this year. We're going to go into each of these a little deeper to give you an idea of what's changing and some additional considerations as you're planning for areas that you may be impacted. And like I mentioned, as we're going through them, I'll ask Maria to maybe send this as a standalone handout as well. Kind of just use this as your reference throughout the year to look back and say, yeah, you know, these AMT exemptions, that may impact me, and kind of track what's going on. And obviously, Lumsden will be sending out newsletters and pushing out updates on LinkedIn as things do develop so that everyone understands, you know, where they stand and what things might impact their tax situation going into 2026. And I will note, obviously, when we put this together, we tried to keep it very factual, what we know now, no speculation on what might change, what might be extended or modified. So this is really just what we know is supposed to extend at the end of 2020 or expire at the end of 2025. And in general, we're seeing things revert back to the pre-2018 code, adjusted for inflation. So we're going to start out looking at the individual tax rates. The TCJA lowered the tax rates as well as adjusting the range of income in each bracket. So when TCJA expires, the tax rates and income ranges are all going to return to the pre-TCJA state. So these charts that we're looking at here lay out the 2025 versus 2026 post-TCJA rates and income ranges for a married filing joint taxpayer. All of the 2026 numbers that we're looking at throughout this presentation are all published by the Congressional Budget Office, and I marked them all with an asterisk throughout the presentation. So that's where that data is coming from. If you want to fact check me, Congressional Budget Office published all of this. So as we're looking at these two charts, we see the income ranges accelerate faster in 2026 versus what we currently have in 2025. And I highlighted an example here, a taxpayer that has taxable income of $350,000. In 2025, they're in the 24% tax bracket. In 2026, they are projected to be in a 33% tax bracket. So that's a significant change that you would want to be aware of. The other thing to keep in mind is that as we are going over other changes in provisions, your income may change significantly between 2025 and 2026, that taxable income number. So essentially what we're anticipating, if this does expire, is that your 2025 and 2026 taxable income could be drastically different just based on the provisions. So a good first step is understanding what tax bracket you're going to be in based on 2025, but knowing that that likely will change. A few quick changes to individual tax returns before we get into some of the bigger items. TCJA temporarily reduced the personal exemption to 0. This is set to return to $5,300 per person after it expires. The standard deduction, this was increased significantly by TCJA and will return to the pre-TCJA levels. I have them listed here for a married filing joint taxpayer. They had a standard deduction of $30,000 in 2025. That will be reduced to $16,700 in 2026. And the child tax credit is reduced to $1,000 per child with a much lower income phase out. This means fewer people are going to qualify to receive this deduction if the act does expire. The phase out in 2025 was 400,000. In 2026, set to go down to 110,000.
All right, everyone, it's polling time. So I launched the first polling question. If you guys could answer. As everyone knows, Lumsden is so proud to be in this historic building, and our renovations came out great. So if you're out and about, if you have a client appointment coming into the office, I think you'll appreciate all of the new features that the building has. So we'll give this another 10 seconds and then I will close it out. All right, I'm gonna end the poll. And we'll share the results, and the majority of you were correct. The building was erected and completed in 1888. So moving on.
Thanks, Maria. So the mortgage interest deduction is the next one we're going to talk about. Prior to TCJA, taxpayers who paid mortgage interest were able to deduct interest on the first $1 million of mortgage debt. TCJA lowered that limit to $750,000 for debt incurred after December 15th, 2017. After TCJA expires, that limit is going to return back to $1 million, regardless of when the debt was incurred. So this means mortgage interest on debt incurred between December 2017 and December 2025 is going to be calculated based on the first $1 million, even though it was limited previously. The other change has to do with home equity loans. TCJA restricted interest deductions on home equity loans to only funds that were used to enhance the property financed. After expiration, interest on the first $100,000 is deductible, regardless of the purpose of that loan. Then two small changes on itemized deductions here. For miscellaneous expenses, the Act did eliminate the deduction for miscellaneous expenses. At expiration, we'll be able to expense these items again, subject to a 2% AGI floor as they had been in the past. So these items are unreimbursed employee expenses, tax prep fees, the small things like that. And then personal casualty losses. The Act limited the deduction for personal casualty losses to claims occurring within a federally declared disaster area. At expiration, that will be expanded, and any non-compensated loss would qualify for this claim. That federally declared disaster area stipulation would be lifted. Moving on to the SALT deduction, this is probably one of the most talked about provisions of TCJA. The SALT cap limited the deduction for state and local taxes to $10,000 a year. After expiration, the cap will be lifted and taxpayers will be allowed to deduct the full amount of state and local taxes again. After the SALT cap was enacted, a lot of states began establishing PTEP programs to help mitigate the loss of these itemized deductions. Under these programs, pass-through entities paid state income taxes at the entity level, took that deduction from their ordinary income and passed a credit along to taxpayers to then claim on their state income tax return. So there has been speculation that if the SALT cap is eliminated, there'd no longer be a need for these PTEP programs. However, let's consider tax returns of the business owners who are receiving that deduction. May see themselves in AMT. So if you have a Schedule A deduction, which was where your SALT deduction lies, that's going to be subject to AMT limitations added back, and you may not receive a benefit from that deduction. That means the PTEP programs may still be more advantageous, likely are not going away anytime soon. This is going to be an area to keep an eye on to see if this ends up being extended, if this is extended with modification, what exactly is going to happen here and how that's going to impact your 1040s. The limitation on itemized deductions. Under TCJA, overall itemized deductions are no longer limited. After this expires, limitations are going to return if your AGI exceeds certain thresholds. Based on the estimates that we're seeing, we expect the threshold to be around $400,000 of adjusted gross income. So if income exceeds that threshold, your itemized deductions are going to be reduced by 3% of the excess. So in this example, a taxpayer has AGI of 500,000. This is 100,000 over the threshold, and that means 3,000 of their itemized deductions are going to be disallowed. Moving on to charitable contribution limitations. Under TCJA, charitable contributions up to 60% of AGI are deductible. After expiration, this threshold drops back down to 50% of AGI. From a planning perspective, if you are considering any significant contributions that could approach this limit, try to maximize your deductions before that is reduced. This would be if you have any intention of making a large philanthropic gesture, if you want to set up a CRUT, if you're considering donations to a family foundation or to a donor advised funds, make sure you are getting the maximum benefit for setting up those sorts of plans. And the excess business loss limitation. This temporarily disallowed a deduction for business losses. This is one of the few provisions that we've already seen extended beyond the end of 2025. The Inflation Reduction Act extended this into 2028. This means that losses in excess of the established threshold for 2024, that's $610,000, cannot be deducted. Instead, these disallowed losses are treated as an NOL carry forward. We will continue seeing that $610,000 adjusted for inflation every year, but this one is still in effect until the end of 2028 now. Moving on to AMT exemption and phase outs. Expiration of the TCJA is going to result in lower phase out amounts. In 2025, the phase out is 1.25 million. In 2026, we project it being around 210,000. So we're looking at a significant decrease of that phase out amount. The lower phase out means AMT is going to be triggered more frequently in households with income in the $200,000 to $600,000 range. This next bullet is an interesting point. Prior to TCJA, 5.2 million taxpayers were affected by AMT. In 2023, which was our most recent filing season, only 200,000 taxpayers paid AMT tax. So this really shows the extent of people that were affected by the AMT phase outs, that would be affected by the AMT phase outs if they are reset to the previous levels. Quick little refresher, if you have been lucky enough to not think about AMT in a while, AMT requires that you pay the higher of tax calculated on your regular income or your AMT income. So when you're calculating your AMT income, you are required to add back certain deductions. So the state and local taxes, personal exemptions, depreciation adjustments, things like this all go into the calculation of your AMT income. So this ties into when I mentioned earlier, the self-deductions may not be advantageous for a taxpayer that has to pay AMT tax. This is why, because you're recalculating your income and not allowed to take those deductions for your AMT income. If your AMT income is under 235,000 in 2026, you fall into the 26% tax bracket. If it's over 235,000, it would be in the 28% tax bracket. So you might be looking at these rates and remembering that first slide we looked at together where we saw the tax brackets laid out and thinking, I'm already in a higher tax bracket than that. The recalculation of AMT income could drastically increase the amount of income that these rates are being applied to and result in a higher tax liability. So there's a lot of moving pieces to consider here with the possible return of AMT. And then I'm going to go over the estate and gift tax exemption quick before I pass it back to Maria for the next polling question. So under TCJA, the estate and gift tax exemption was essentially doubled and set to go back down to the previous levels. So we see here our exemption for 2024 is 13.6 million per decedent. That's going to go back down to 6.8 million. at the end of 2025. So if your goal is to move as much value out of your estate as possible, consider maxing out your annual exclusion gifts. These currently are $18,000 per individual. So if we had a married taxpayer with 2 children, they can each gift $18,000 to both of their children. That would allow them to transfer $72,000 out of their estate each year. The other option is to utilize your lifetime exemption to make substantial gifts prior to the exemption dropping back down. And if this is something that you're considering, don't wait till the end of the year. Don't call someone on December 1st and say, you think maybe you want to take advantage of that, because that's not going to be enough time to put together a good plan. So if this is something that you think you want to have a conversation about, make sure you reach out to someone to start that process, now, not waiting until later this fall. And Maria has your next question here.
Okay, everyone, polling question number 2. Which of the following was not housed in Buffalo Cyclorama building? Give it a few minutes. The building is probably most known for one of the items on that list. Let's see, where almost everyone has answered. We'll give it another 10 seconds or so. All right, so I'm going to end the poll, and the correct answer, we'll share the results, is indeed the grocery store. It was never a grocery store. In 1942 to 1963, it was the Grosvenor Library, which is now merged and exists at our existing downtown library. And of course, it was also a roller rink and a taxi garage. All right, stop sharing here and back to you, Amanda.
All right, thank you very much. So the pass-through income deduction is pretty straightforward, but could have a major impact if it does go away. Under TCJA, a deduction of 20% of your qualified business income is allowed on a taxpayer's 1040. This benefit will be eliminated when TCJA expires. So you may want to consider trying to find ways to accelerate some income into 2024, or possibly delay expenses in order to really maximize that deduction. If you do utilize QBI, work with your CPA to understand how this may impact your taxes when, possibly if, this expires.
Amanda, I'm just going to jump in real quick. I just want to remind everyone, if you do have any questions, don't forget to put them in the Q&A box, and after Amanda's session, we'll answer those questions. Thank you.
So corporate tax rate, this is another provision that is not going to change after TCJA expires. This is a permanent provision. So prior to TCJA, the corporate tax rate was 15 to 35%, depending on the level of income calculated. That changed to a 21% flat rate, and that is what will remain going forward. Bonus depreciation. So TCJA temporarily allowed 100% bonus depreciation on all purchases of new and used property that was placed in service after September 27th of 2017. It's slowly being phased down, heading towards 2026. As we can see here, was being decreased about 20% every year after 2022. So after the phase down period is complete, bonus is currently set to sunset. This is another one to keep an eye on, because Congress loves extending bonus depreciation. We just have to track what rate they're going to allow it potentially. But this is a moving target, so reach out to your CPA if you're planning any significant expenses. Right now, we know what bonus depreciation is going to look like through the end of 2026. We'll wait and see if there is any changes to that going into 2027. But I think this is a good example of the same fact pattern in one year versus another could give you a totally different result in income. So definitely, communicate with your CPA if you have questions on trying to maximize between bonus depreciation 179, looking at the changing rates over the years. All of those factors are going to come into play to kind of help you understand the timing of purchases and how that's going to impact a taxpayer's 1040 at the end of the day. So the interest deductibility limitation, TCJA limited the amount of business interest expense that can be deducted. The act said that net interest expense cannot exceed 30% of adjusted taxable income. So that is the interest expense that you're paying offset by any interest income that you receive. That net amount cannot be more than 30% of your taxable income. If it is, that excess is limited. There is no set expiration in this one, but it is subject to possible action. We could see a limitation of the percentage or possibly some simplified treatment for small businesses. So this is going to be another one if you find yourself over that threshold to keep an eye on. Then if you have foreign activity, I am admittedly not a foreign expert, but I did want to share some rate changes here to be aware of. And if you find yourself concerned about these things, reach out to your Lumsden advisor and they would be happy to assist. The base erosion minimum tax rate is going to increase from 10 to 12.5%. Guilty deductions are going to be reduced from 50 to 37.5%. And the foreign derived intangible income is going to drop from 37.5% to 21.875. So if you do have foreign activity, if you're wondering how expiring provisions may impact you, reach out and have that discussion. Again, now rather than later, so that you can kind of plan for the future and understand what might be changing. So this should be familiar from the start of the presentation. Now that we've gone over all the provisions, this version gives just a brief reminder everything's going to be changing. So if you want something to kind of take a look at later in the year and say, what was she talking about? I know I made a note that that might impact me, but I couldn't remember how. This is going to be a nice resource as a refresher. Like I mentioned, we don't know right now what might be extended with modification. So if you at least know what's impacting you, it kind of gives you a little roadmap to pay attention to everything that might be coming out. And, we obviously will be sharing out updates as we get them and as we have more concrete information to help everyone kind of navigate this and make decisions for themselves and their businesses. And that is what I had on TCJA. So if there were any questions, I'm happy to answer them. If not, I'm going to pass this over to Austin so he can go over kind of some more current events on things.
Yeah, thanks, Amanda. I appreciate it. I'm going to share my screen here now. A little technical difficulty. It's not letting me share my video, Maria, saying it's used by other apps.
Amanda, why don't you log out and stop sharing and we'll try that. Oh, Austin, your presentation went away. Okay. Austin, can you share again?
Yep.
Okay. And then Amanda, why don't you stop sharing?
Find my stop sharing button, sorry.
Okay, Austin, why don't you try it now? Sorry about this, everyone. Not sure what the technical issue is here.
Can you see my screen now?
Yes, we can see your screen.
For whatever
We
reason,
can't
it's
see
saying that
you.
it can't.
Your video is off, Austin.
It's saying my camera's being used by other apps and it's not letting me share my screen. So
okay, we'll have to just go with it without seeing you then.
Well, I apologize, everyone. So just to give you a little introduction, I know Maria did the intro in the beginning. My name is Austin Robert. I'm one of our in-house full-time financial advisors in our financial services department. I'm going to be going through a quick market update, discussing some current things we're seeing. Tariffs, inflation are the big talk lately. And then I'm going to kick it into the Secure Act 2.0 retirement plan provisions. There's a lot of provisions that are taking effect starting in 2025 and forward. So I'm going to talk about some of those and some opportunity to maximize some retirement planning strategies along with some of the expiring tax provisions Amanda touched on. So the first slide I want to show is, I think this is a pretty powerful slide. This shows the return of $1 in the S&P 500 index if we're invested from 1926 to 2023. So it shows nearly a century of market performance. And I know, going into last year, there was a lot of questions around volatility surrounding the political election. And as you can see from this chart, despite recessions, wars, political shifts, the market has maintained a long-term upward trajectory. Obviously, the red being, Republican president and the blue being a Democratic president. I think the key takeaway here is that the market has trended higher regardless of which party is in power. Of course, there's been volatility. You have the periods like the Great Depression, the dot-com bubble, 2008 financial crisis, and also the COVID year that we had even more recently. But it's critical to notice that long-term investors who stay the course are the ones who are ultimately rewarded. And I think that as we look towards upcoming tax changes, interest rate discussion, and potential market volatility, the key is to focus on staying invested, having a sound financial plan, and not reacting to any short-term noise. So I'm going to go into the polling question here for Maria.
Okay, everyone, I just launched poll question number 3. What is the original purpose of a cyclorama building? There's actually 3 left in the United States. Looks like based on the answer so far that everyone is getting it correct. So we'll give it another second. Well, a few seconds. We will end the poll and I will share the results. It is correct. It was to house panoramic art. And the first was the Crucifixion of the Christ. The second was the Battle of Gettysburg. And a docent would walk around with a lantern and explain each of the panels of art that would then tell a story. And the Battle of Gettysburg actually exists in original form at a museum in Montreal, Canada. They have it in storage there. So anyway, just some cyclorama.
Oh, there's my web camera, so that works. Perfect. Thanks, Maria. Just to reiterate, looking further into one of those pullbacks we saw, so going into the 2008 financial crisis, it gives us a lesson talking about that. Don't listen to the outside noise, right? If we're looking into the time when the actual recession was announced, you see by that point, we've actually already hit our bottom with the pullback there almost. And then by the time the recession was announced, you see that the market had already rebounded to that point. So a lot, I think it just reinforces the idea that the markets, they're not waiting for the official announcements. You don't want to try to time the market and, go off of things that are going on in the media. Just, again, reiterating, staying the course and following a plan. And this actually shows a good depiction of the cost of trying to time the market. So in this hypothetical, if you invest in the Russell 3000, which is just the 3,000 largest US publicly traded companies, from 1999 to 2023, this is what your return would be on that investment. If you miss the best week, then your return obviously drops down about $1,100. And then you see by missing the best month, 3 months, and 6 months, just continues to drop and decrease the return that you see in that. And so again, just staying invested, focusing on the long term, not trying to time the market and listen to the outside noise is crucial when you're doing your financial planning. So we'll go into the actual market updates, what we're seeing right now. Some current updates. January kicked off really strong. We saw equity markets posting solid gains. The S&P 500 ended the month up 2.78%. The Russell 2000 index ended the month up 2.62%. And then we saw the international markets, both developed and emerging markets, had 5.26% and 1.81% returns as well. And then if you look further into the sector performance, 10 out of the 11 US sector performances ended January positive, which was great. It was led by healthcare and financials. And we noticed that the one negative sector was technology. And I'm sure a lot of people have seen the noise with, the DeepSeek emergence, the Chinese AI company. developing some cost-efficient AI software, which has raised concerns with the US's AI leadership, AI having led the way for technology for the last couple of years. So we've seen companies like NVIDIA have some short-term volatility recently as a result of that. So, just given how AI has been such a key part of the technology sector, that's something to know and see how that, you know, unfolds. Again, NVIDIA has rebounded a little bit, and that's just another example of short-term noise creating short-term volatility. But in the long run, we'll see how that pans out. Bonds in the fixed income side saw a solid month. Despite volatility in rates, taxable bonds and muni bonds both saw a total return of about 0.5% to end January. We can expect some volatility. I know the Fed is discussing, what their policy is going to be and what to do with future rates, and that'll lead into our next, segment here about the trade wars and tariffs that we've been hearing a lot about in the news. So obviously, recently we've seen the new tariff measures imposed on our trade partners, Canada and Mexico, with 25% tariffs imposed on most goods imported. And also China faces 10% tariffs on almost all imports coming into the US. The response to this, as you can imagine, has been retaliation. So we're seeing these countries, they're not sitting idle. They've announced retaliatory measures against the US, which could escalate tensions further. And the economic impact of that, well, economists are warning that the tariffs may lead to higher consumer prices, thus inflation. And everyone, obviously gets concerned about the word inflation. And heading into the year, it was anticipated that the Fed reserve policy was going to be to cut rates and reduce rates, but we actually this week they announced that they're going to take a wait and see approach and see the impact of the tariffs and see what the impact, if any, on inflation before they make a decision. So they decided to stay kind of where they're at, between the 4.25 and 4.5% rate. And some of the sectors that face significant impact are the automotive industry, agriculture, energy, and consumer goods industries are the ones directly affected by this tariff news. Now, going back to the inflation, a lot of our clients ask us, inflation's been the big topic for the last couple of years. And, initially, again, people were expecting the Fed to cut rates, but with the news of the tariffs and potential inflation rising, people wonder if that's going to hurt their returns or have a negative impact on the market. And the answer is not necessarily, right. Stocks can still they can still have strong returns. And, in 22 of the past 30 years shown on this chart, we've seen positive return even after adjusting for inflation. So the inflation adjusted return in the S&P over the last 30 years was actually 7.5% return. So again, just staying invested, staying the course, and, historically, over the long term, investors grow wealth even in inflationary environments. So just to recap, what does this mean, right? Again, the markets don't care who's in the office. Historical data shows that the long-term growth, despite political shifts, is the way to, maximize your investment strategy. And by being in the market and not timing the market, that's how you're going to have the best, results and impact on your plan. Do not be reactionary. We try to avoid greed and fear. The greed of trying to, maximize your returns by thinking you can outsmart and time things versus the fear of, some disaster happening and then sitting on the sidelines and missing some of those opportune days and time periods that we saw in the previous slide. And I think most importantly, work with your accountants and work with your advisor, build a plan that works best for you. Every investor, every client situation is unique. What they need in terms of tax efficiency, their risk management, and the diversification needed for their specific investments are obviously to be tailored to them. Not everyone is the same. Not everyone needs to be invested the same. And now I'm going to go into the Secure Act, and I think that presents us a big opportunity when it comes to financial planning, is how do we maximize our retirement and tax efficient accounts? And with the Secure Act, which was passed in 2019, it is the Setting Every Community Up for Retirement enhancement. It was initially passed to increase access to retirement savings, enhance tax benefits and address some longevity risks in retirement planning. I think initially, the goal of this being passed was to have, some self-funded retirement, and so people weren't so reliant on Social Security. This act was actually further extended and enhanced in December of 22 with the Secure Act 2.0, with the goal to build on the original Secure Act and refine some of the retirement rules. So we'll talk about some of the original provisions in 2019. We see that the RMD age was actually increased from 70 and a half to 72. The part-time employee eligibility. So this was for businesses. In the past, full-time employees were the only people who were required to have eligibility in the plan. This extended that to part-time employees who worked 500 hours or more for 3 consecutive years. They were deemed eligible for plan provisions and were required to have access to participate in 401k plans, or simple IRAs, and any employer plans offered. They also added some 529 flexibility with the ability to repay student loans up to $10,000 per beneficiary. And I think something that's really important was the tax credits that were established for new plans. So initially the credits were covered plan costs up to $5,000, and there was an auto enroll credit where if you had employees who became eligible based on the plan guidelines, if they had a provision in their plan that automatically enrolled these employees, you'd get a tax credit of $500. One of the biggest and most impactful things was the elimination of the stretch IRA. So the stretch IRA in the past, if you passed away and the IRA went to a beneficiary that was non-spousal, so children, grandchildren, or anyone that was not a spouse, you had up until your lifetime to withdraw that IRA. The elimination of this required a new 10-year distribution rule where you're required to fully distribute the inherited assets within 10 years of the original owner's death. And if the original owner had already begun their RMDs, you were required to take those RMDs on the same schedule for the first 9 years and then withdraw the remaining balance of the account in the 10th year there. And if the owner hadn't originally started the RMDs, you had flexibility over that 10 years. You could, wait till you're 10. You could take it over the course of 10 years. And that's where, you want to work with an advisor and your accountant to make sure that the tax efficiency of that. There were a few eligible exemptions for this. Obviously, surviving spouses are not subject to that 10-year rule. Minor children aren't subject to the rule until they reach the age of majority. Individuals who are less than 10 years younger than the deceased were eligible to take that over their lifetime. And then beneficiaries who were either chronically ill or deemed disabled were also able to take that over their lifetime as well. Another provision was the penalty-free withdrawals for births and adoptions up to $5,000 from your IRA or 401k if you take that within 1 year of birth or adoption. And then we'll go to the next polling question before the next part.
All right, everyone. So this is our last polling question, and we couldn't forget about Valentine's Day, which is on Friday. So what was Cupid's name in Greek mythology? Wow, you guys are all pretty smart here. Everyone's getting it. So we'll give it another second here. Excuse me. All right, I'm going to end the poll and share the results. And yes, the god of love is Eros. So most of you got that correct. So the second choice was Apollo, and that is Apollo is the god of sunlight and music. Okay, turn it back to you.
Thanks, Maria. So the Secure Act 2.0 further expanded on those original provisions we discussed, right? The RMD age increased from 72 to 73 starting in 2023, and it will actually continue to increase to 75 by 2033. Another big RMD rule was the exemption of Roth 401ks from RMDs. So originally, if you had Roth money within your 401k, you were subject to that same RMD schedule as pre-tax dollars in your traditional 401k or traditional IRA. Now Roth 401k dollars are now exempt from those RMDs. One of the big ones was the auto enrollment rule, and that's actually taking effect as of 1/1/2025. So all new plans established after December 29th, 2022 and going forward must have an auto enrollment feature. And auto enrollment, just to reiterate, is essentially if you have an eligibility requirement of 1 year. So if an employee starts after 1 year of service, they become eligible in the plan. Auto enrollment means that they're automatically enrolled at a default rate that you set between 3 and 10%, and then they have an auto escalator every year after that on the anniversary of their eligibility of 1%. So employees can opt out of this, but it's just important to know, because if you do have a 401k in place currently, make sure you're discussing with your TPA advisor and record keeper that these required provisions, if it applies to you, that they're in place and you're prepared for that. And there's some exceptions, obviously, plans established before that date, but also any employers with 10 or fewer employees, any new businesses that have been in place for less than 3 years, and then church and government plans are also exempt. But it is important to note that once you reach that minimum 10 employers or more, you're eligible for or you're required to set up this auto enrollment rule, and the same for new businesses. Once you hit 3 years of age for the business, then you're required to set up this auto enrollment into the plan. Extended provisions even further were, updates to matching contributions. So you can now match employee Roth 401k contributions on a Roth basis. Previously, all matches were done with pre-tax dollars. So if an employee matched or made a contribution into their 401k as a Roth, the company match was always done as a pre-tax dollars. Now the employer can elect if they want to do Roth matches in place of the pre-tax dollars. And also you can match student loan payments. So if employees have a lot of student loans and they're making payments to those and not able to contribute to retirement, employers can elect to also match student loan payments and have those dollars go directly into their retirement accounts, which is a big benefit. 401k part-time eligibility was expanded. So instead of 3 years, part-time employees only needed 2 years of 500 hours or more to qualify for the plan. And one of the most important pieces of the Secure Act 2.0 that they expanded on, I think, is the enhanced tax credits. So there's the continued startup credit that they had in the original Secure Act, where up to $5,000 per year for 3 years to cover plan costs. And it's calculated as now greater of $500 or $250 per non-highly compensated employee, which is deemed as anyone who makes $155,000 or less in the year prior, and then every year it's indexed for inflation. So for 2025, the way that they deem a non-highly comped employee is looking back, and if they earned under $155,000 in 2024, they're deemed as a non-highly comped employee and can be calced in this contribution credit. Also, non-highly comped employees cannot be owners. They cannot be anyone who owns 5% or more of the company, and they can't be anyone who is a spouse, child, parent, or grandparent of anyone who owns the company or owns 5% or more of the company. The big addition was the employer contribution credits, which now for profit share contribution, matches, safe harbor contributions for plans, you can now, for employers with less than 50 employees, give a contribution of $1,000 per employee, and then there's a 5-year phase out for that credit. So for example, if you have 40 employees that are meet the non-highly comped employee threshold, and you give over $1,000 to each of those employees, that's a $40,000 tax credit in year one. So it can be a massive, massive incentive to set up the plan, but also contribute to the employees as well. Further expansion, super catch-up contributions. Now there's a specific super catch-up for employees who are ages 60 to 63, where they can, in place of the regular $7,500 catch-up, they can do the greater of $10,000 or 150% of the normal catch-up rate, which for this year, it is the 150%, so it's $11,250. is the catch up for this year, for this super catch up for people in this age. I get questions, is it the year I turn 60? Yes, it's the year you turn 60, you can do the super catch up. And then the year you turn 64, you're not eligible. You have to go back to that original $7,500 catch up. Another provision that's starting next year that's important to note is that there's a mandatory Roth catch-up for employees with wages exceeding 145,000 indexed for inflation every year. So all of their catch-up contributions are to be made on a Roth basis. So they no longer get a deduction for catch-up contributions if you're making over 145,000 starting in 2026. And obviously that'll be, a key thing to take note if you're making those catch-up contributions currently. Or if you have employees who are making catch-up contributions in your employer plan, make sure that they get the education and are aware of that provision. Another is the 529 plan to Roth IRA rollover. In the past, if you set up a 529 plan and you didn't use the funds, if your kid didn't go to a college or didn't have any qualified expenses to use those funds, there's really nothing you could do. Now they have a provision where you can actually roll up to $35,000 in your lifetime for each beneficiary. If the plan's open for 15 plus years, it can be rolled into a Roth IRA, but it's subject to the annual Roth IRA limits. You can't roll the entire $35,000 into a Roth in year one. It has to be over a couple of years based on the limits. So just going back to, some of the provisions that might be expiring on the tax side, and when we're looking at retirement planning as a whole, some of the strategies we can discuss or look at maximizing is your 401k contributions, your IRA, SEP IRA, or even a cash balance plan. By maximizing your retirement accounts, you're not only, getting those deductions or allowing that money to grow tax-free or tax-deferred, but that money, goes directly back to you and is grown in retirement and helps you, fund your retirement and build that retirement savings. So it's important to, work with your advisor. If you have a business, look at plan design and structuring the plan to maximize your benefits. Or if you're an employee, make sure you understand the provisions of your current employer plan and how you can maximize your benefit within that. And then some further, opportunities are, maximizing the Roth conversions. I know Amanda gave us the update that today we got news that they're looking at extending. But if they weren't to extend, and obviously it's proposed as of right now, some of the opportunities we could look at are converting pre-tax IRA and 401k dollars to Roths at the lower rates now, as opposed to waiting until those rates, shift into higher tax brackets. And now we're doing those conversions at higher rates. And then also, when it comes to investing, just looking at tax efficient investments like maybe municipal bonds if you're a higher income earner, or capitalizing on some tax loss harvesting with some strategies like direct indexing and things like that. But at the end of the day, ultimately make sure you work with your team, you work with your advisor and your accountant to make sure you're building a plan that's structured and tailored to you, because I think that's where you can maximize the most in terms of your retirement planning. At the end of the day, the market is, if everyone had a crystal ball, then there would be, no need for planning because we could just predict. But same as, tax laws are subject to change, the market's always subject to change. And it's important that, you build a proper plan and stay the course and work with your team. So I'll open the floor for questions, I think now, right, Maria?
Yes, I
Perfect.
don't see any questions in the chat. We'll give it 30 seconds if anyone wants to throw in a question. Of course, both Amanda and Austin are available if you want to discuss your specific circumstances with them, or any of the advisors here at Lumsden and McCormick that you may work with. So please reach out. Like I mentioned and Amanda mentioned, we will be sharing this presentation, the recording, and the slide deck, as well as any updates based on, new legislation that comes out based on the proposed updates or staying the course with this tax act that may be coming out with the new administration. Actually, we just had a comment that someone commented that it was a great presentation, so we appreciate that. So again, once we end this, a evaluation will launch for everyone. If you could take the time to answer it, it's 10 simple questions. Most of them are multiple choice. So again, if you guys could complete that, it would be appreciated. So any questions, reach out and we'll be connecting with everyone again soon. Thanks, everyone.